Hi, this is Drew Tignanelli. This is our latest client update, December 15th. We sent it out in email on December 10th, and we did it in two parts on that email. One was an executive summary for somebody who just wanted quick bullet points as to what we're talking about, and then a longer version for somebody who wanted a little more detail than just the bullet points. Now we're doing the video, which a lot of clients also have greatly appreciated. Some don't have the time or desire to watch a video, but some do, and they truly appreciate it. So we want to try to meet the needs of all people, depending on whether it's a quick summary, it's a little more written detail, or if it's a complete video. But as we do the video, I wanted to introduce you to more of the team, because this company is not about Drew Tignanelli, it's about the team of people that are here and their capabilities. So I'm going to have Tim Maurer do the client update today. He's the other senior advisor at the Financial Consulate, and in the future you'll meet other people like Chuck Bender, who's the head of the investment team, or Roger Bear and Sue Fenimore, who are also part of the investment committee. So for right now, I want to turn this over to Tim Maurer, and he's going to give you more of the details of the client update December 15th. This is Drew Tignanelli saying God bless.
Thanks, Drew. You know, these are unprecedented times that we're in, and we continue to enjoy having the opportunity to serve you. What I'd like to do is answer a few of the predominant questions that we're all thinking these days, starting with, could this market actually go up? The answer is yes. There are enough reasons to believe that people are sick of selling and people want the market to go higher. It almost seems like on certain days that the market really wants to look past the bad news and go up further. And certainly we would all enjoy seeing the market go in the upward direction, but we believe that there is still more risk on the downside than there is potential upside, and therefore we continue to limit our equity positions. Is this the next Great Depression? It's a great question, but we don't think so. The reason is that in the Great Depression, we actually were suffering from deflation as the money supply decreased by as much as 33%. Our money supply now continues to go up, and with all of the opportunities for companies emerging that they will be able at low interest rates to go out and get money to go do more business, we do believe that those companies will have some advantages that they did not have in the Great Depression. Additionally, while we do expect to see more bankruptcies in 2009 and maybe even beyond, we don't think we'll see the wholesale bankruptcy problem that we had in the Great Depression. Interestingly, though, we do fear that the policymakers are in such uncharted waters that they don't actually know how the stuff that they're doing is going to work, whenever it's going to work. So then the question is, could it get worse? Unfortunately, we think that answer is yes. Unemployment is rising rapidly, more rapidly than expected. Foreclosures are up and on the rise. Housing is still down and going lower. We're also starting to see an awful lot of municipalities suffer. States that are having difficulties meeting their pension obligations. Those are reasons for fear. People that weren't feeling the recession back in August, September certainly are feeling it now. And one of the reasons is that the economic growth over the course of the last 5 years was almost directly tied to someone's home equity. So people were utilizing that equity inside of their home, not the actual cash that they were making. And as a result, now seeing that drop to about zero for an awful lot of people, that is the equity number in their house. We do expect that the economy will continue to suffer from a consumer perspective. We also would suggest that you take a look at your personal situation and see what response you might need to have to this current recession. Should you have more liquidity on hand? We believe that you should. Just in case, for example, if your job becomes shaky, you'll be able to meet your obligations on the home front with 3 to 6 to 9 months of cash to keep you floating. We do think that that is very important right now. So, have you heard the term capitulation recently? This is a term that normally is not used in the common vernacular. And these days it's thrown around as much as the name Joe Flacco in Baltimore on a game day. And, you know, yesterday was a rough one, but I'm sure that he'll get back in the game. So, I think that most people don't really realize what this word capitulation means. It means complete surrender. That means that all those who have been the buy-in holders for this period of time would say, finally, I give up. I don't want to play this game anymore. We haven't got there yet. So we do believe that a capitulation is going to be in the near future, but we cannot exactly pinpoint when that's going to be. So what are we doing for now in our portfolios? We're preserving capital and then seeking interest and dividends. In addition to small amounts of equities, most of you have between 0 to 30%, depending on your risk tolerance. We also have short-term U.S. Treasuries that are guaranteed. We have FDIC brokered CDs in the accounts that aren't making phenomenal rates of interest, but it leaves that money there available for us when we do go to redeploy it at the time that we think it's appropriate. Now, what are we expecting for the future? A lot of the same stuff that you've heard us talking about for some time, but there are some new wrinkles in this. Commodities are down over 70% this year, with the U.S. markets down only around 40% only, unfortunately. So we think that there is more opportunity for commodities like oil and agricultural commodities to go higher than there is for the U.S. markets to go higher, and they're down significantly more. We believe that that poses a great opportunity. Similarly, a lot of the Asian countries have experienced more of a downturn than the U.S., likely due to the great markets that they've been having in the last 3 to 5 years. Again, we believe that there is more opportunity there with these Asian countries, countries like China, Taiwan, Hong Kong, South Korea, and Japan, than there is here in the U.S. as we try and put the pieces back together on a completely disentangled financial system. Now, I think that you should continue to expect to see weekly and daily market gyrations in the extreme. We'll see optimistic spikes when people really want to see the market go where they want it to go. We will also see heavy selling after some people get to a point where they say, all right, now I got a little bit back, and then the sellers come in and start to wipe the market out. Days like up and down 150 points have become commonplace, with the norm actually being 300 and 400 and 500 point ups and downs. But it's our job to stay objective at this point in time. We will attempt to be neither bearish nor bullish, neither desperate nor hopeful, but instead both cautious and observant. That's our job, and we look forward to doing that for you. As always, I hope that you'll contact us with a phone call if you have any questions about this or our other thinking, as this stuff changes almost on a daily basis, and we'll look forward to talking to you then. Thank you.